those are individual trades coming through at this point in time. But let's go back to the Motilal Oswal Annual Investor Conference, which is, of course, in its third day today. Gautam Duggad was with us earlier when the conference was kicking off. He's back now to give a summation of what he's picked up. He's Director and Head of Research Institutional Equities at Motilal Oswal. Gautam, welcome back. So you told us, you'll tell us on day 3, what are the key learnings? So distill it down for us from a market standpoint. 3 highlights. Gautam, what's the feedback like? And as I said, your takeaways really.
Hi, Prashant. Good afternoon. Good to be here. So, the conference has a long, backdrop of global macro headwinds, tariff, and on top of that, we are all anticipating the announcements on GST. So that was the high point of the conference. Everyone is second guessing what's going to come today or tomorrow. Second, we've had excellent sessions in the CEO track across manufacturing, industrials, consumption, and of course, we had a very prominent speaker on GST too, Mr. Raju Memani. So a lot of speakers highlighted opportunities on manufacturing over the next 3 to 5 years. Consumption, which has been a very weak point for last couple of years, especially the low-ticket consumption goods, that is seeing some interest coming back. Obviously, there is a short-term kicker in the form of GST. So let's see what actually transpires out there. And third, among the plethora of investors I have spoken with over the last 3 days, both domestics as well as FIIs, the eye is sharply on the corporate earnings. When will the corporate earnings revive? Because the macro, the global geopolitics, all of this will keep coming and going. But what truly drives the market, as we've seen in the last 5 years, is corporate earnings. When earnings were solid between 2020 to 2024, with a compounding of 20% plus, we saw market took off. And then in FY25, when earnings were flat, we saw market give 0 returns. So everything else falls by the wayside once earnings come back. And if earnings are not there and everything else is rosy, markets still won't respond. So those are a few of the important highlights that I just thought I'll, enlist.
So low ticket consumption is one space where you are seeing a lot of interest, and there is a case to be made for things to improve and pick up. What else? Based on the corporate speak, the corporate interactions that you've had, which are the other pockets that you would be most bullish on at this juncture?
So auto is clearly the highlight. We've upgraded auto luckily just before this whole discussion around GST began. We upgraded auto from being underweight to marginal overweight in July during our preview. And now auto seems to be the biggest beneficiary of the potential forthcoming GST rate cuts. So the sentiment around auto has picked up. We saw that in the month of August. Auto index rallied 6%. And now auto is the best performing sector of the calendar year 25 YTD. It is overtaken banking, right? So clearly there is a lot of sentiment buoyancy out there. Auto numbers are fine for the month of August. There is festive season around the corner. The rural sentiments have picked up. And on top of that, there could be a GST boost. So that is one sector which is clearly seeing a lot of interest. Second is EMS, and for the right reasons. There is huge growth out there, which we have seen for the last 2-3 years. Stocks have done well. We ourselves are projecting 50-60% earnings compounding in many of those stocks that we cover. We cover roughly 8 to 10 EMS stocks. So clearly big opportunity out there. Though the profit pool still remains quite small, but the growth prospects are huge. And what is happening right now, Rima, is in a market where the earnings growth is settling between 8 to 10%, any sector, any company which is doing upwards of 20% is getting disproportionately high valuation premium from the investors. So any sector, like for example, we're seeing huge interest in cement because cement this year is going to post more than 50% earnings growth. Prices are stabilizing. Government has kickstarted a capex. They've front-loaded the capex in the first quarter. So that sector is seeing good demand. Then we are seeing a decent demand in the sub-categories of discretionary consumption. Jewelry, hotel, we had a very prominent speaker in the CEO track on hospitality. The demand is still outpacing the supply out there by a margin of 2 to 3% on a compounded annual growth basis. So hospitality should remain a very, very interesting space still, despite performing exceedingly well over the last 4-5 years. And then lastly, I'm seeing some interest emerging in technology, not necessarily the traditional legacy tech players, which are growing at 4-5%. So that's not seeing too much of interest. But midcap IT is seeing very good interest. Then, of course, the likes of QSR, the likes of food delivery players. We had unlisted, food delivery company out there, which painted a very, very bullish picture for next 3 to 5 years, with the category itself growing at 20% plus CAGR. So segments and sectors which are trying to outperform the market in terms of the earnings growth right now are seeing disproportionate interest. We were in a very different environment between 2020 to 2024 when every sector was growing well. So today, the scarcity premium on growth is running at a very elevated premium.
I'm glad you touched upon that last piece on technology, Gautam. Hi. I was just coming to that. Quite curious to know, because I think the market and investors are already looking for new age tech ideas now, whether that is, like you mentioned, food delivery, quick commerce, or even look at some of these stocks which have a bit of a semiconductor play attached to them. E2E networks is one, NetWeb is the other. Some talk of GPUs and servers, which they'll be putting out for some of the government tenders as well. But you tell us, beyond some of the names that you mentioned, anything else that you're looking at in newer age technology? There are more listings happening as well. For instance, from the consumer tech space now, Urban Company is going to be listing very, very soon. So what are you watching out? What's the new frontier of technology or AI, whatever little plays we have here?
So very good point, Sobi. We've seen definitions of the sectors evolve over the last decade. Initially 10 years back, financials was all about private banks, PSU bank. Then came NBFCs, then came capital markets, then came insurance companies and fintechs and what have yous. Same thing happened in consumption. 10, 20, 15 years back, you only had staples. The discussion was between lever and ITC. Then, you saw so many subcategories evolve in the discretionary space that today we have 3 consumer analysts in our team. Now, something similar is happening in tech. If you're positive on tech for the last 4 or 5 years and you were overweight on the traditional legacy names, you underperform by a wide margin. Whereas the new age tech companies have delivered fantastic returns. We just initiated coverage a couple of months back on delivery. The whatever target price the analyst had for 12 months was achieved today in less than 2 months. So clearly, fund managers, asset allocators have to be on the edge because the definitions are changing rapidly. And if you are evaluating the sector with the past lens, the possibility of you missing out on the new age or, the emerging trend is quite high. So as far as tech is concerned, as I said, if you're looking at tech, then it's very important to identify companies which are at least growing upwards of 15%, because the days when 5-10% growth was attracting huge premium seems to be behind us. In fact, one of the data points I was looking at, in December 21, the IT sector had a close to 20% weight in Nifty 50. Today it is somewhere about 10.2 or 10.3%. So in a matter of 4 years, a big sector like IT has seen its weight in the benchmark index half, right? And it's obviously a consequence of a very prolonged period of suboptimal growth. So you're going to see similar trends evolve in various categories, be it industrials, be it consumption, be it financials, be it technology, or be it even healthcare. Even in healthcare, we are seeing that the modern health tech or the new age, healthcare companies taking market share away from the traditional guys. So the job of an asset allocator has become even harder in the last few years. And as you rightly mentioned, more and more companies are going to list in the next few months or quarters. And who knows, in 3 years or 5 years, the composition or the complexion of the benchmark indices will itself change meaningfully.
Hi, Gautam. Good to see you. And, you spotted that delivery and the other one, I think, is car trade. Both of them went ahead and they bought their smaller peers. And suddenly that market itself for them became much wider because the nearest possible competitor was taken over by them itself. That said, we're going to be turning the spotlight on the metals space. And that's moves more according to momentum rather than according to, what's happening on the fundamentals. How are you placed out there? What's the view? Because the coming months should be very good. For ferrous as well, things will look up because the government is playing its part. How are you all positioned out there?
Nigel, that question is for me?
Yes, on metals.
Yeah, okay. So look, on metals, oil and gas, commodities, usually we've always kept a very underweight kind of a stance because it's very difficult to time those sectors. As of now, we are very selective there on metals. We like Tata Steel, we like Hindalco. And we also heard very positive commentary from JSPL, or I know the name has changed. But look, I mean, it's very difficult to second guess the commodity prices given the churn that is happening globally on both growth, geopolitics, and demand capacity. I mean, the demand supply mix, which is ever evolving. So for now, from our portfolio point of view, we know that the sector has done reasonably well in the recent period, and even the earnings were slightly better than expectations. But for want of predictability, because it's very difficult to predict those commodity prices, and the fortunes of the sectors change very rapidly, we generally tend to be conservative out here and keep our positioning slightly neutral to underweight more often than not.
Gautam, let me ask you, at the end of the conference, right, do you have added conviction on something which you were unsure about? Or from an investor point of view, I mean, I'm sure, stuff which investors wanted, companies which investors wanted to meet, lots of these names which are kind of beaten down, and maybe, it's always the case. People watching closely if there is a turn happening, or any changes broadly in your assessment of companies, if you can name 2, 3.
Sure. So, Prashant, look, at a big event like this, when there are 1,200 plus investors and roughly 200 corporates, and so much happening both domestically as well as globally, always going to be a lot of, discussions around portfolio strategies and changes and what to look at, given that the market has been range-bound for more than or almost 12 months now. So we've had a decent period of time correction. So a lot of conversations happened around portfolio construction in this times, what needs to change. For example, I'm seeing some interest back on hitherto ignored sector like consumer staples. Now, it can be very opportunistic given the events which are lined up over the next few days, but at least I heard few investors discussing consumer staples, which I've not seen for a long period of time. Similarly, people who have a slightly contra mindset, they're getting, excited about large cap IT because no one seems to be talking about it. And for right reasons, because the growth has been very, very subpar. But those with contra mindset have seen 3-4 years of underperformance of large cap tech, very attractive risk reward in their view. So those are sectors which are seeing some interest coming back after a very, very long time. Amongst the ones which are already performing well and where we have seen renewed and continued interest is auto, consumer discretionary, capital market players. There's a whole host of capital market companies representing at our conference. Electronic manufacturing services, EMS, defense, right? We had a very interesting session by former Army Chief yesterday in our CEO track. So clearly, there is a lot of interest in some of these spaces which have already been doing well. But at the margin, to address your query, consumer staples, large cap IT are some segments where after some time we have seen some interest emerged. Okay,
that's some ideas where I think there will perhaps be some tactical or otherwise, but pockets to think about really in that sense. Gautam, thank you very much for joining us and telling us what's been happening at that conference. Very, very busy with 1,200 plus investors, lots of CEO tracks, lots of meetings, etc. So that's Gautam giving us the intel from there. We'll take a quick commercial break here. We're going to come back.